Hi, everyone. This is Gianni DePoce, and I'm an instructor over at TheoTrade, a wonderful trading community. And I want to take some time today to walk through some of the basics of technical analysis, as well as share with you what some of the various indicators and price patterns, and even how candlesticks work to an extent. So we're going to walk through some of these basic steps to kind of get you started in the study of technical analysis. So by definition, technical analysis is the study of price and price patterns. You may have heard phrases like the trend is your friend, and we'll talk about why that is the case and what that actually means. You may have heard of technical formations like the head and shoulders pattern or the rectangle or the ascending triangle, for example. And all of those patterns have their place within technical analysis. And when you can tie them all together, as a trader, it can help you synthesize a really nice story and ability to trade any given market. But most importantly, it helps you manage risk. And anyone that has been in the business of trading long enough knows that risk management is the most important component of trading. Anyone that lasts in this business is essentially a professional risk manager. This is not gambling. There's a difference between speculation and gambling. And we can talk about some good risk management strategies as well. But what I want to start off with today is just understanding price. So what we have here is a daily chart of the S&P 500 index on the screen. And, we are fresh off of new all-time highs that were registered yesterday on the 24th of January, 2024. And many of you have probably heard the old market saying, oh, I want to make money by buying low and selling high. And that's great. That is obviously the easiest way, or so it would seem in theory, to make money. But in reality, most people tend to sell and capitulate near the lows, and most people tend to buy and capitulate on the long side near the highs. It's the same reason why, even just a couple weeks ago, when Bitcoin made its high, that most people were calling for it to go to 100,000. And now it's coming back down pretty significantly. It's dropped almost $10,000 or more from that price. So why is that? It's important to understand the collective psychology of trading. And technical analysis is a really good tool to help you do that because there are various studies and indicators that can help you achieve that goal. There's a saying kind of on the periphery of trading that goes, mathematics is the language of the gods. And regardless of what you believe, from that standpoint, humans aren't as rational as you would think. And it turns out that some of this can be quantified to a degree mathematically. And I think that's a big reason why technical analysis works. Now, like any other system, it is not 100% accurate. It is not 100% foolproof. There is an element of subjectivity and a level of interpretation that the technical analyst needs to apply. So it is, in a sense, an art in addition to the science. The science would be the purely objective component of it. And, from the standpoint of objectivity, I could sit here and tell you that the objective truth was that on the 24th of January 2024, that the S&P 500 hit a new all-time high at 4,903 and 68 cents. That is an objective truth that, cannot be disputed because that is what we registered as the all-time high. And then I could also, objectively state that the S&P 500 closed on the 24th of January 2024 at 4,868 and 55 cents. That is objective. But what does that actually mean? That's where the subjectivity comes in. Does that mean that stocks are going to continue going up? Does it mean that stocks may go sideways? Does it mean that stocks are going to go down? So technical analysis helps you understand where price may go. And then the question becomes, well, is technical analysis predictive? And I would say, no, not necessarily. It's all based on probabilities. To know where you are going, it helps to know where you've been. And, there's the saying that history repeats itself, but I don't think that's exactly true. I think that history rhymes more so than repeats. And as long as history rhymes, you can find a rhythm. And if you're in tune with the rhythm, you can position yourself accordingly to make some profits in the market. So let's go ahead and start off by talking about price. And, there are four main points of price on any given day. So let me go ahead and zoom in so you can see a little bit more closely here. And you have the opening price, which is, self-explanatory where the open of the day is. You have the high price of the day, which is the high price of the day. You have the low and the close. Now, most people, when they use candlesticks, can look at a candlestick and tell you what all of those data points are and how the market behaved on that particular day. So I'm going to walk through some basic candlesticks and just explain how markets behaved based on the candlestick price action. So if we go ahead and take a look, for example, at this low here, back on the 27th of October, 2023, that was a pretty important day. Okay, and so if you look here at the candlestick, the way it works with these is that the left side of the body of the candlestick, where the full body is, represents the open. So that would be that point right here. Okay, right on that corner where my cursor is. The close is the lower body, and it's on the right side. Okay, and I'm using candlesticks, but some people use open, high, low, close bars. It's generally the same concept. Okay, so the high of that day was at $4,156.07. That was just that was about $4 higher, a little bit less than where we opened. So I'll actually zoom in real closely here. It's actually this candlestick right here. You can see there's like a little wick, okay? And there's like a little wick on the, candlesticks next to it too. So what that represents is that there was actually a price that was higher in the S&P 500 than where it opened that day. Okay, so it opened right there. That was the high. And then you have the close right here. Now, this little wick, or the shadow, if you want to call it, some people get all, particular about that. I think it's kind of semantical, whether you call it a wick or a shadow on these candlesticks. This represents the low price of the day. So the low price of the day was at $4,103.78. So basically, it worked like this. You opened there, and then the high of the day was registered at that upper wick. The low of the day was registered at that lower wick. And then you closed right there. And because it was red, you know that it closed lower on the day. Okay, so let me zoom back out here. And we can look at a couple other examples of up days. So on the subsequent day, you had a price gap. Okay, so that's what this is right here. Prices gapped up, meaning that they opened above where they closed the previous day. That's why the body of the candle on the left side here is above where the closing part of the body of the previous candle was. So we opened the next day, which was a Monday, the 30th of October. We opened at $4,139.39. And the low of the day was just slightly lower. Okay, it was about $7 lower. So there's a little bit of a wick down there. Then you rallied up. You rallied to a high that day of $4,177.47. But then you closed slightly off that high. Okay, you closed that day at $4,166.82. Now, on the next day, you can see that you actually opened slightly above where you closed. There's a little bit of a gap in between. It's very little. But what happened is you saw that gap get filled, meaning that prices actually traded below where they closed the previous day. That's why the wick of the candle actually fills that gap. But it turns out that prices were able to rally back above where they opened that day. And they essentially closed right by the high, because the high that day, you can't really see the candle wick in this case because the closing price was so close to the high of the day. The high was $4,195.55. And the close was $4,193.80. Okay. So I'm not going to get too deep into candlestick patterns today. I mainly want you to understand how they work. Okay. So there are all sorts of, candlestick reversal patterns, but I will say this, they tend to last, 1 to 3 days in length. And as a rule, they really are only significant at certain turning points of the market. So, particular candlestick patterns that you observe may not even manifest according to their stated objective within the midst of a trend. So I'll give you an example. Looking at one right here, okay? I'm not gonna, like I said, I'm not gonna spend too much time on these candlestick patterns, but in this particular case, you had what's called a bearish engulfing candlestick, otherwise known as an outside day if you use bars instead of candlesticks. Now, what that entails is that you had the opening price of the day and the high of the day that was above the opening price and the high of the previous day, and you had the low price of the day and the close of that day below the close and the open of the previous day. The candlestick engulfed the entire body of the previous day. That would normally be a sell signal. But you can see here, what did stocks do? They rallied up for the next 4 days. And then they paused one day and then continued up another 3 days higher. So that's why, I really am just keen on you knowing how candlesticks work with respect to their open, high, low, and close. Because a lot of times, new traders, they will learn the candlestick patterns and they become enamored with the idea of reversals happening very quickly, and they start trading off the price action of a day. That's a mistake that I made at the beginning of my career, and it's one that I hope that you can avoid doing for yourself as well. Now, if you go ahead and take a look at this here, you had a bearish engulfing, but once again, on the next day, you gapped up, and you spent a couple days going higher, but eventually you did reverse. Okay, but if you made the trade based on this close, depending on when you set your stop loss and when you entered your trade, I mean, if you set it at the close, you might have been stopped out if you were trading futures, right? Because that's quite a big move, depending on how many contracts you're trading. We're looking at an index right now. You can't actually trade the S&P 500 index. You can trade the S&P 500 futures market, but that's something I will talk about in a little bit. But the point I'm trying to make is that don't become so enamored by the price action of a single day. By definition, one day does not constitute a trend with respect to price action. Okay. So now here we are. We can fast forward to today, and you can see that for 2 days in a row now, obviously the market hasn't closed yet, but yesterday and today, this was the case. We are trading below where we opened. In fact, yesterday on the 24th of January, prices opened at 4,888.56. So they opened right here in the candlestick. I'm going to zoom in. They opened right here. Okay, we traded up on the day, and then we faded into the close. Now, what does that tell you? If buyers commanded the open, but sellers commanded the close, how would you say the day ended? To me, it would say that the day ended as a victory for the bears. Okay, but then we gapped up again. Here on the 25th of January, we gapped up on the S&P cash index and we opened at $4,886.66. We rallied to a high of $4,898.15. We did not take out that previous high. And once I start talking about trends in a little bit, you will discover how that may be significant. It's still too early to tell yet, but there are starting to be some of the preliminary signs at this point that perhaps the integrity of the bull trend is under threat in the S&P 500, just in the near term, by the way, okay? But once again, we are seeing bears kind of take control of the intraday trend, meaning that we are seeing more selling pressures during the day, during the actual trading session itself, than during. I mean, now if you were to compare it to, let's see, what would be a good example of where we opened lower, but then closed high on the day? We don't really have a lot of instances like that. Well, here's one. Yeah, we can use this example right here on the 17th of January. Okay, so we actually gapped down on the day. So the previous day on the 16th of January, we closed at $4,765.98. Prices gap down. That's why the left side of this candle is lower. Okay, so we opened lower. We opened that day at $4,739.13. We traded lower, trading as low as $4,714.82. But then bulls woke up. Bulls woke up and bid the market higher into the close. We closed, we actually closed higher than when we opened. We closed just slightly higher than when we opened. It's only like 8 cents. So, not the best example, but a recent example nonetheless. We closed a few cents higher, and that's why the candle is green. Okay, because you closed up on the day. But this is an example of a day that began bearish, but ended bullish. Okay. So that's how the candlesticks work from a purely pricing standpoint. Okay. And again, it's 4 data points. You can look at you can look at a candlestick, or I should say you should be able to look at a candlestick and be able to discern how the market opened, what the high was, what the low was, and what the close was, regardless if you knew what the actual numbers related to that price or to that day were. Okay. So that's the beauty of candlesticks, is that with one icon or one graphic, if you will, you can pack in quite a bit of data, simply from an observational standpoint, and that's very nice. Okay, so what I want to do is I'm actually going to jump over to the S&P 500 futures. Okay, so that's ES. And the reason I want to do that is I want to talk about volume. Okay, because volume represents the number of, in this case, the number of contracts traded per day. Okay, if you're looking at a stock, like we can look at Apple stock real quick. The trading volume on Apple stock, we can see here that on the 25th of January so far, there have been about 31 million shares traded so far. Okay, so a little bit below its average so far, but all volume represents is the number of shares in the case of a stock, or the number of contracts in the case of a futures market that are being transacted on that particular day. Now, the difference between volume and open interest represents the number of contracts in the case of a futures market or a derivatives market that are still outstanding, ones that have not been closed. And you see these little dips here. They coincide with the, so I have the open interest line drawn on the volume bars here. And what you see here, this looks to be an anomaly. But every time the contract rolls over, because futures contracts have an expiration date, whenever they roll over, there's a massive liquidations. All the contracts are closed or settled in the case of a financial product. In the case of a commodity market, there may actually be, delivery or transference of a particular commodity or good. That seems to be the exception nowadays, but once upon a time, that was more so the case. So that's what the volume means. It's simply the amount of transactions taking place on a given day. Okay, so obviously the S&P 500, you can't look at that, but what I want to do now is go back to the S&P 500 just for simplicity's sake and talk about what constitutes a trend. So I began the discussion today by talking about, I mentioned the phrase, the trend is your friend. You've probably heard that phrase before circulating amongst the trading community. And that's because the trend is your friend. At least the trend is your friend until the trend ends. And there are ways to discern when a trend may be nearing its end. But as a general rule, the longer that a trend goes on for, the longer it will continue. Now, that may seem counterintuitive because you've often heard the saying, well, buy low, sell high. But there's also a strategy that the numbers and the data suggest works very well. And that strategy concerns buying high and selling higher. We're not going to get into that today. It's beyond the scope of the discussion. But that strategy works because trends exist. And John Maynard Keynes, whether you agree with him or not, when it comes to economics, I certainly have my disagreements with him, but he once astutely said that the market can stay irrational longer than you can stay solvent. So what we need to take away from that saying is that it's generally advisable when speculating to trade in the direction of the underlying trend. Now, what constitutes a trend and, on what time horizon? Well, let's answer the first question. An uptrend is characterized by a series of higher highs and higher lows. So if we begin with this low here back in March of 2023, what do we see following it? We see higher highs and higher lows. Now, there can be pauses in trend. In fact, you can make an argument, depending on the time horizon that you were looking at, that there was a brief pause in the trend, between April and June of 2023. Okay. But if you actually zoom out, you'll see that it was just a temporary anomaly. And that's why time horizon matters, right? Because you might actually observe a short-term bear trend within an intermediate term uptrend and a long-term uptrend as well. You may observe a short-term bear trend within an intermediate term sideways market within a long-term bull trend. Okay, so once I start looking at different time horizons on the S&P 500, it's my hope that that will make more sense. But let's look at an example of a potential downtrend. So let's go to the highs here from July of 2023. And what do we see? We see a low that didn't quite take out the previous low. So, you could say, oh, well, that was a higher low, but then you rallied back up and you made a lower high. So that was the first thing that disturbed the integrity of the existing bull trend. Then you rallied back down, made another higher low, you made another lower high. Then it said, uh-oh, you started selling off, and then you took out this low here. You made a lower low. So then you had a series of lower lows and lower highs. You were in a downtrending market in the short term. And that continued until we got to October. And if you compare the October low to the previous two, arguably even three lows, it was lower. But then you start to zoom out and go back and you can say, oh, well, the October 2023 low was actually higher than the May 2023 low, and it was higher than the March 2023 low. So again, time horizon and context matters. And ever since this October 2023 low, the market's been making higher highs and higher lows again. Obviously, we had confirmation of the bull trend when we broke out to a new all-time high back in December. But the first signal that we had as trend followers that the integrity of the short-term downtrend between July and October was no longer in effect was when prices took out the high from October in November. You had your first case of a higher high, which nullified the subsequent cases of lower lows and lower highs. At that point, you could say it was a mixed trend. You had higher highs and lower lows. Okay. Then you started taking out the previous highs. Then, the market started running away. And if you didn't follow other various technical indicators and patterns, you got left behind in the dust. But I'm starting with the topic of trends because, again, the greatest magnitude of price moves that take place in a market will generally occur in the direction of the underlying trend. Okay, so this is a weekly chart of the S&P 500. Obviously, 2022 was not a good year for stocks. Okay, but going into 2022, you saw higher highs and higher lows. Stocks were at an all-time high back in January of 2022. But then once we dropped to that low in January that took out the low from October of 2021, that was the first warning sign. You rallied back up, formed a lower high, and then dropped and formed another lower low. You rallied back up again into March of 2022. You actually took out the previous high from January, but compared to the all-time high, it was a lower one. And then stocks got pummeled lower, and they kept making lower lows and lower highs. You then had a nice rebound, nice short squeeze into August of 2022. Lower high again. We dropped to new lows. Okay, so this was definitely a bear market, not just from a percentage standpoint. I think it's a lot healthier from a technical perspective to use a series of lower lows and lower highs to constitute a bear market versus the arbitrary 20% rule of Wall Street, and to use a series of higher highs and higher lows as a metric to measure bull trends in a market versus the arbitrary 20% rule. So, what happens if a market falls 19% and is making lower lows and lower highs? Is that not a bear market? What happens if a market rallies 19% off the low, spends several months consolidating only to continue higher? I mean, you could have used that period of consolidation to be accumulating on the long side. So again, arbitrary numbers may not always be your friend, is the point I'm trying to make. So let's analyze coming out of this low. When did we know from a trend following standpoint that the rally could be something special? Well, we rallied out of this October 2022 low. We hit a high in November of 2022. It was a lower high, so there was still reason to be concerned. But then we dropped into December of 2022 and formed a higher low. So at that point, as trend followers, you start to, I suppose, open your mind up to different possibilities. So you have your higher low, you rally, and you make a higher high in January of 2022. So from simply that standpoint, from the principles of higher highs and higher lows, you could have arguably been fully long at that point. Now you dropped over the next, couple months into a low in March, but what happened again? Higher low compared to the previous significant low, which was in December. And then stocks took off. They made another higher high. They kept rallying, didn't stop until July. And then we had a nice correction into October. But once again, what did we have? We had another higher low. And now we just made a new all-time high. So really, if you were just following the trends, okay, the trend following principles, it was basically, let me redraw that for you. It was basically by right around here, okay, when you took out this high from here and you had the higher low. So you had the higher low compared to the low in October of 2022, in December of 2022, and then you had the higher high in January of 2023 compared to the high in November of 2022, okay? And so now, as stocks are selling off a little bit here in the near term after hitting a new all-time high, what would we theoretically look for in order to reinforce the integrity of the uptrend? We would look for another higher low. Okay, so, we look for a low. And in theory, even if we fall all the way down here, we don't want to see this low taken out, because then that disturbs the integrity of the uptrend. So I think by now you get the idea, but one last thing I want to touch on while we're on the discussion of trends has to do with, the duration of these trends. Or I should say, trends within trends. So obviously, you had the global financial crisis of 2008, 2009, markets dropped then. And I actually want to take a look at the NASDAQ. We'll look at the NASDAQ 100 in this case, just to mix it up a little bit. But you can see here that, the NASDAQ didn't take out that high from October of 2007 until April of 2011. Okay. So that's why you have to combine other indicators aside from just trend following. But what has been, the biggest moves? Where have they been? They've been to the upside. Comparatively speaking, all the moves to the downside since 2008 have been significantly less in magnitude compared to moves to the upside. And that is another characteristic of a bull trend. Okay, so, you can look here at the NASDAQ 100 and see long-term higher highs and higher lows. You had a period here in 2015, 2016, where markets went sideways for almost 2 years. They did nothing. Then you had a period here, in 2018, 2019, where markets didn't do all that much either. And then obviously you had a period in 2022 where markets actually fell pretty significantly. So those were pauses within the longer term bull trend. And you can even make an argument that, you had a little period here in 2011, and even a little bit of a period there in 2012. But aside from that, you had pretty clear trending markets, 2013, 2014, 2017, 2020, 2021, 2022 was down, and 2023 was a really good year. Okay. So again, know where you are in the trend. The trend is your friend until the trend ends. So I think you've had enough of my discussion on trends. We'll move on to the next subject. But I wanted to start off with trends, in terms of conceptual matters after, how candlesticks work, because it really is so important to understand the directional bias of markets. Okay, now obviously when the trend rolls over, it's going to happen first on the shorter time interval. Okay, so even if you're in a longer term bull trend that's about to turn bearish, it's going to turn bearish first on the short term interval, meaning that you'll see a series of lower lows and lower highs across a couple of months before you'll see it across a couple of quarters or even a couple of years, right? Or you take it a step further, you'll see lower lows and lower highs form across a couple of days or weeks before you see it happen across a couple of months or a couple of quarters. Okay. Now, the next thing that I want to talk about with you has to do with support and resistance. That may be another technical concept that you've heard before, but it is a very important one because it turns out that these are really good ways to measure supply and demand on a particular chart. And the way that I use support and resistance, I like to give a greater weighting to horizontal levels of support and resistance versus sloping support and resistance. Well, what does that mean, Gianni? Well, I'll explain that in a moment. But I'm going to start off on, longer term time scales because, whenever a longer term level of support or resistance breaks, it is more significant. But what does that mean? Well, seeing support or resistance break on a monthly, weekly, or daily time interval are not equal. I would argue it's more significant to see support or resistance break on a monthly time scale versus a daily time scale. So, for example, going back to, the NASDAQ 100 here, you had resistance, a zone where, sellers came into the picture. I wanted a trend line there. There we go. Where you had sellers that drew a little, there we go. You had clear selling activity in this zone, between at the time 2000 and 2400, give or take. It's pretty crazy to think that the NASDAQ 100 once upon a time was back in that price zone. Okay, now the reason I drew two lines is because I think that support and resistance zones are just that. They are zones versus hard lines, right? So if I were to draw a line like this, okay, just one line, you'll see examples where the market will trade above it, even close above it, but then go back below. It's because these are zones of congestion versus hard lines. Okay, so this was a resistance zone. Okay. And then you had another resistance zone, I would argue, on this monthly chart, here between 4,600 and like 4,800. Okay, and I'll zoom in and show you some, closer examples so it's easier to see. Then you had a zone there, 7,800, 8,000 resistance. And then you had some congestion here, like in the 10,800, 11,000 area too. Okay, so this is where some of the subjectivity of technical analysis can come in. You have to look for areas of price congestion. And wherever price is congesting or spending time either being rejected to the upside or the downside are more often than not support or resistance zones. Okay, so even most recently, okay, you can see the NASDAQ 100, there was some resistance here in the 15,000, 16,500 zone. Okay. Now, one key thing to understand with support and resistance is that whenever resistance breaks to the upside, that price zone becomes support. Whenever support breaks to the downside, that price zone then becomes resistance. So we'll look at some more practical examples on shorter time intervals so you can see it better. So we'll go to the weekly chart. I'll delete these drawings. Okay. And we'll look at some more shorter term levels of, support or resistance. So I would argue you had some resistance here in the NASDAQ on the weekly here around 15,000. And then, call it here like 15,500. Okay. And I say that because you saw prices kind of get rejected to the upside here, fell back down, rallied back up. It was above there a little bit. And they kind of extend. I'm actually going to change my type of drawing. Because I think you can get, let's see here. Maybe not. I'll just extend it to the right. Extend to the right. Okay, because these zones go on forever, basically. Okay. So we see that it looks like this 15,200, 15,000, or 15,700. That's not exactly a straight line. That's why I was off. Let me redraw that for you. There you go. I'll just draw it like that. It's probably easier. Yeah, that was a better line there. So you can see here how there's been some price congestion in this zone between 15,200, 300, and 16,300. Okay. You saw prices trade in that zone at the end of 2021. And then when you broke back below it, what do you see on the subsequent retest in March of 2022? You saw prices be rejected. You saw former resistance, or excuse me, former support, which was support here, become resistance. And then I would argue you had some right here too in the 13,500 area, even right around here, 12,600. Okay. So you saw even when prices were selling off, when we began the market correction in 2022, we bounced off support and then we rallied up to resistance. We dropped back into support, fell below it, rallied back up to it in August of that year, were rejected again at resistance, which was formerly support, and fell back lower. When the rally started, we saw the initial rejection in this price zone. Look where the shadow or the wick of the candle was, right in that resistance zone. And it was formerly support. We traded back below it, got back into it, spent a few weeks consolidating, and finally broke above it. And then it became support. Okay? And if you even want to get into it, you can say, there's some resistance, or there was some resistance or support there. We finally broke above it. Okay? And then when stocks rallied into July of 2023, we were rejected at longer-term resistance, dropped back below it, fell into longer-term support, found a higher low, and rallied back higher. Okay? So now let's do this on an even shorter time interval, because it's going to take a while for you to train your eyes to do this. And like anything else, you're going to need to spend time looking at charts. Okay? You actually need to draw these support and resistance zones in order to start to see them. Otherwise, it's just, I guess, lines on a screen. They make fun of technical analysis online of just random lines on a screen. Like your charts should be clean. Okay. So let's look at some short-term support and resistance levels here on the NASDAQ 100. So you have, this $12,900 area. Well, actually, let me redraw it a little bit lower. Let's put like 12,700 there. Okay, you can see prices spent some congestion there. Okay. Prices were rejected here. They got rejected again. They finally broke above it. They came back down, retested it, started to rally higher. Okay. Once we got into this zone here, okay, we saw prices come down from the high in July. So that would tell us there's probably some resistance in this 15,700 zone to 16,000. Okay. You could even draw a support line because you saw prices spend some time in the zone between 14,300 and 14,600. Okay. But let's look at this particular example, the resistance zone between 15,700 and 16,000. So we saw prices get rejected by that once, twice, almost a third time before finally trading into it and spending, about a month in there. Okay. So this was clearly a very important level of resistance. And once we started to break above it, it became support. And we almost came back down to retest it earlier in January. And then we just continued higher. So now I would say you have some resistance now, or it was resistance, now support in the $16,800, $17,000 area. So that's going to be a key level to watch in the NASDAQ 100 cash index to see if it holds. If stocks do start to sell off here in the coming weeks and we break below that support zone in the 16,000, was that 16,800, 17,000 area, that will then become resistance. We could come back down to retest this, 15,600, 15,900 area, or 15,700, 16,000 area. No guarantees, we're forward looking, but this is how support and resistance works. Okay. That's how it works horizontally. Now I want to draw trend lines because trend lines can offer sloping or diagonal levels of support or resistance. Okay. And I prefer horizontal lines, and you can see why, because there's been instances where prices will spend time, congesting in those levels. But here's an example of a trend line. So by definition, you need to have at least two lows for a trend line to matter or to be drawn. Okay, so you had a low here in March of 2023, and you had a low here in April of 2023. We then bounced off it again in May and followed it pretty closely, almost hit it again a second time in May, and then rallied higher. Now, I view breaks of horizontal levels of support and resistance as more significant than sloping ones because there's always a connotation whenever support or resistance breaks. There's a bearish connotation when support breaks, and there's a bullish connotation when resistance breaks. So we broke this upward sloping trend line here in August, but markets didn't exactly collapse, right? They kind of just went sideways. Now, then we had a downward sloping trend line drawn there, and then we broke back above it, after one test, okay? And so then that's not a really strong trend line. They become stronger the more lines that they have. Okay, so I'll delete this one. You can see that the trend line that started here from the July high, you had it tested here in, it was drawn after the high in August. It was tested again in September. It rejected, tested again in October, and rejected, and then it finally broke above there. Okay. Then if you have this upward sloping trend line, if you drew it there, we broke it recently. But guess what? We saw it tested a third time, and then it broke on the fourth time. Did the market collapse lower? No. What happened? We rallied higher. So to me, when these sloping trend lines are broken, it's more of a signal that the rate of ascent or the rate of descent, the rate of ascent in the case of an upward sloping trend line, or the rate of descent in a downward sloping trend line are no longer intact. Okay, so let's actually zoom out and look at some other examples. So, what if you drew it like that? Okay. So that's why I'm not really a fan of sloping trend lines because they can be pretty arbitrary. What if you use that line instead? What if you use this line instead? There's always another high to draw it from. In the case of a downward, there's always another low to draw it from on an upward. So that's my, personal take on it. You may find it works better or differently for you. But you look at this trend here. You have a trend line there. You broke it on really the second test because it was drawn after the first, point. And, on this example here, you broke it, only corrected for a couple months, and then resumed back higher. So those weren't as meaningful in my view as the horizontal breaks of support and resistance. Okay, so that's enough of the whole concept of support and resistance for now. What I want to move on to now is the whole concept of indicators. Okay, so starting off on the concept of indicators, we are going to look at the RSI indicator, which is displayed on the bottom of this chart here. I like to use the RSI indicator. You may like to use stochastics or MACD or whatever else you may use. Sometimes I use the commodity channel index, the CCI, for various commodity markets. But when I trade stocks or currencies or bonds, I'm using the RSI indicator. And it's important to understand that indicators are secondary in nature when it comes to making a discernment or a judgment on a chart. We are not trading the indicator. We are trading price. Price is the ultimate indicator, and that's why for the majority of this video, I've spent time discussing what price means on a chart and various tools with respect to price. And I'm not even done, because we're going to talk about price patterns, kind of touch on the surface of price patterns once we finish the discussion on indicators. But indicators really are meant to serve as confirmation. Okay. What does that mean? Well, they're there to either confirm the presence of bullish momentum in a bull trend, or the waning or lack thereof in a bull trend, or they are there to confirm bearish momentum in a bear trend, or the waning or lack thereof. Okay. So we talked about trends for quite a bit of time in this video. And in the NASDAQ 100, we clearly see an uptrend, right? Now, in looking at the RSI indicator, the way this one works is that you have an overbought reading above 70, and you have an oversold reading below 30. So whenever you have an overbought reading above 70, it tells you that there is an overwhelming number of bulls or overwhelming number of buyers present in a market. Now, for those that are new to this game, that can be frightening, because you may be accustomed to the phrase buy low, sell high. Oh no, the market's overbought. The RSI indicator is above 70. I should sell short. Well, let me ask you this. Was this necessarily an area to sell short? Sure, but we're missing part of the picture, and you'll see why. Was this a good area to sell short? Nope. Was this a good area to sell short? Nope. Was this a good area to sell short? Nope. Was this a good area to sell short? It was a better one. Why? Well, because we had what's called a case of bearish divergence in price in the RSI indicator. Now, was this a fantastic area to sell short? Not really, because the magnitude of the drop wasn't that fantastic. You would have had to hold a counter trend position for a month, and that's not very comfortable, I can tell you that. Okay. Now we see that again, a case of bearish divergence. Stocks rally to a new all-time high, and we have a lower reading on the RSI indicator. Now, admittedly, the NASDAQ 100 is not the best example because it's been so bullish, but it is a good example in showing how a large number of buyers, as indicated, a market that is overbought per the RSI indicator, is not inherently bearish. And that's why I wanted to display this for you here. Okay, so you can see how many overbought readings we've had in the last year. You've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So per the RSI indicator, you've had 10 significant periods of it being overbought. Is the NASDAQ 100 something you wanted to own in the last year? Yeah, I would argue so. I would argue that the NASDAQ 100 is something that you wanted to own. And so that's why overbought is actually, it can be bullish. It can be bullish because there's an overwhelming number of buyers. Okay, so don't just become so enamored with these, divergence signals, and you start trading against the trend immediately. Now let's look at a weaker market in the Russell 2000. Okay, and I'm actually going to zoom out here, because the Russell 2000 has been the weakest stock index for quite some time. And here's a really good example of bearish divergence. What does that mean? Well, look at what happened. The Russell 2000 hit an all-time high. The last time the Russell 2000, which is a small cap index, hit an all-time high was in November of 2021, and we haven't gone back to those highs ever since. Meanwhile, the NASDAQ 100, the S&P 500, the Dow Jones have all hit new all-time highs. So not all stocks are created equal. But look at the magnitude of this divergence and how long it went on for. This was a divergence that was in effect for basically, what was it? The previous high was like in March and then in November. So 8 months. So you had 8 months of bearish divergence. It was very wide. The prices on this all-time high, you couldn't even get an overbought rating on the RSI indicator. That is a big signal that upside momentum has waned. And so the longer that the divergence goes on for, and the wider that the divergence is, in the case of bearish divergence, the more powerful of a sell signal it becomes once you get confirmation from price. Now, it can give you an idea of when you want to reduce your profits or start to, raise cash, take some chips off the table. It's very helpful in that case. Okay. But I find it more useful to confirm in the direction of the trend or to let you know that, hey, the momentum of the trend is starting to wane. And per physics, we know that an object that changes directions will lose momentum before direction is actually changed. Okay. So this momentum lost to the upside in the Russell 2000 was going on for eight months. And then we started a bear market, lower lows and lower highs, right? Lower lows and lower highs. We took out this low, we took out that low. Comparatively here, rallied back up lower high. Then we definitely made a new low, made another lower high. Then we registered an oversold reading on the RSI indicator. Okay, so that told us on the weekly time scale, which is pretty significant in the Russell 2000, that in May of 2022, there was an overwhelming number of buyers. Okay. So when you have an overwhelming number of sellers, let's make sure that's very clear. When you have an RSI indicator reading below 30, you have an overwhelming number of sellers. So the RSI indicator alerted you to the bearish momentum regime in the Russell 2000 in May of 2022. And what did it do, for the next year and a half? Pretty much nothing. Pretty much nothing. Okay. You have some resistance here in that zone. So that's a level of resistance. Okay. Now, what do we see now in the Russell 2000? We see a wide multi-month case of bullish divergence. Price hit new multi-year lows with a 6-month case of bullish divergence. Prices made new low, but the RSI indicator did not. That means that downside momentum waned. Have we had a nice rally off of that low? Yes. Did we make a higher high? Yes. Are we trying to make a higher low? Yes. The trend could be changing in the Russell 2000. This is what we need to pay attention to. And the RSI indicator gave us an indication that the trend could be changing beforehand. Okay. So there are other indicators that can be used. There's stochastics, and you can mess around with that here. You can, if you use Thinkorswim, whatever charting software you have, you can drop them into, your charts. Let me see, stochastics, slow. I use a slow stochastic if I ever do, and it's kind of the same principle. You want to look for divergences. Okay, so we go to the Russell. I have both of them on here. You actually didn't really have the widest divergence in this case, but you did have divergence at the upside here. So indicators, find what works for you, but the general principle is the same. You want to look for instances of divergence at market turning points, and when you're making new highs and you still want to keep a directional bias, you want to see confirmation. Okay, let me get that stochastic off so I can keep the screen nice and clean for you, because now what I want to do is I want to talk some price patterns. Okay, so this is something that's very near and dear to my heart, and we're going to go back to the S&P 500 for this because there's a lot of good price patterns on here. And the thing to understand with price patterns is that they are subject to change and evolution. They are not inherently, fixed. They can evolve, right? And if we go back to the weekly chart here, you can see that the S&P 500, back here broke down from what we would call a rounding top formation. I'm obviously not going to have time to take you through every single chart pattern there is, but there's generally three different categories of what I call in chart patterns. There are continuation patterns, which means there are patterns that you observe during the continuation of a trend. There are reversal patterns that indicate the reversal of a trend, and there are momentum patterns that often present themselves when a market is about to see an acceleration of momentum either to the upside or downside. And truth be told, there's a lot of overlap between continuation and momentum patterns. So that's an example, of a potential topping formation in the S&P 500 on the weekly time scale. You could, make an argument that you had, an inverted head and shoulders formation back here. And chart patterns, like anything else, it's going to be something you're going to have to spend some time observing. I prefer to use horizontal levels when it comes to the neckline of the head and shoulders or inverted head and shoulders formations. You could look here and say, oh, this was a descending price channel, which is a continuation pattern. Head and shoulders formations do have a tendency to unfold as reversal patterns. However, the caveat is you actually need to break the neckline. So we did break the neckline in this case, as represented by this downward sloping trend line. But there are instances, and I'll show you a more recent one, in which necklines are not decisively broken, where you actually see head and shoulder patterns resolve as continuation patterns. Okay. And I'll show you an example of that just not long ago. I remember because we were talking about it in the TheoTrade chat room. And so you have what was potentially a neckline there, a left shoulder there, a head here, and a right shoulder here. Now, there are problems with this particular head and shoulder formation. One of the biggest ones being is that when I look at head and shoulders and I want to see it unfold in a bearish manner, I like to see the high within the right shoulder be lower than the high of the left shoulder. And that was not the case here. So that told me at that time that something was inherently wrong with this head and shoulders. But, if we were to draw the neckline, in this zone here, and I were to use, this as the right shoulder instead of this right here, and actually I could have included that with the head, then it would have been a little more bearish, right? And delete that. That could have been a little more nasty. Delete this too, so you can see what I'm talking about. So this is what I'm talking about. There's an element of subjectivity that the chart analyst needs to employ. So we actually did break below the neckline, but it didn't last for long. What did we have? We had a case of bullish divergence. You can't really see it all that well here, but the RSI indicator did not make a new low in October, and prices springboarded higher. Okay, we ripped higher. So it was a false breakdown. It's beyond the scope of today's discussion, but that does happen. And there's a saying that goes from false moves come fast moves. And you can see it was a very fast move. Now you look here, you get a little bit of a continuation pattern, ascending triangle. That's a continuation pattern. You get another one. You can either call this a rectangle or, I would call it more of a rectangle. These are continuation patterns, and you see them unfold when the trend is about to continue. But again, you need to have confirmation via a close above resistance, in this case of a continuation, and that's represented by the upper horizontal trend line of the triangle or the upper horizontal trend line in a rectangle. So to show you an example of a market that's been in a downtrend with that, let's look at the yield on the 10-year treasury. Okay, I'm actually going to go to the longer term. Actually, we want to do, because that's an uptrend. we're going to look at, but they already have some price patterns drawn on here for you. So you have this inverted saucer that was drawn on here. Okay. It broke below that. And then, we fell just short of our price objectives, rallied back up. I wish, let me see, maybe the shorter term treasury. That's probably a better ZF. Oop. Yeah, we kind of had the similar patterns, but what you see back here is you had a rectangle. That's a good example there. We probably have it in ZN too. Continuation pattern. We were already printing lower lows and lower highs. If you go to the monthly chart, okay, on the short term, you consolidated the losses, which is essentially what a rectangle formation is, and you started selling off to the downside. So let me actually go back to the 10-year note. And sometimes instead of a rectangle, you can see an ascending channel. But what are those? Those are continuation patterns. You get a little bit rectangle there, okay? So when you draw price patterns, you're going to have sloping trend lines. In some cases, you will have a parabola. That's how this is supposed to be, inverted saucer, but, not always, available on the various charting programs that you use. So that's kind of a very quick introduction to price patterns. The way I like to trade is I like to look for price patterns that either confirm the directional bias of the trend. So, in the case of a bull trend, like we've identified here in the S&P 500, I'm looking for continuation patterns. Okay. And so we drew what could have been a head and shoulders formation. But in hindsight, what you could also make on this chart is a descending price channel. And what is a descending price channel? It's a continuation pattern. Okay. Prices were channeling. They rose higher. Another continuation, another continuation. So now we'll see how stocks shake out now. Definitely seeing some sell signals in the near term. I didn't get a chance to touch on Bollinger Bands yet, so we'll touch on that real quick. That's another indicator I use. That's the kind of this band that is wrapped around the price of the S&P 500. And what Bollinger Bands do is they help you measure how many standard deviations away from the mean a market is. So per the principle of mean reversions, the more standard deviations a market is away from its mean, and the longer it goes on, the more likely it is you are to see a mean reversion. So, you can see here that when we had the low back in October of 2023, you had a case of bullish divergence and price in the RSI indicator that indicated downside momentum was waning. We were below the lower Bollinger Band that signaled that we were more than 2 standard deviations away from the mean. And, you were testing, well, depending on when you drew the trend line, you were starting to break below the trend line. So it opened the door for a false breakdown. Okay. So the important thing to understand as we tie up the ends on this video, in this educational session, is that there is an element of subjectivity and room for interpretation and technical analysis. It is not an exact science by any means, but all it lets you do is manage risk effectively. Now, when it comes to risk management, I do want to talk about that very briefly. You need to be having stop losses on your positions. You need to be sizing your positions accordingly. I trade a little bit differently in terms of position sizing, whether I'm trading futures or stocks. When I'm trading stocks, I will never risk more than 1% of my portfolio on any given trade. I usually divide my equity portfolio into, 10% segments per position. Sometimes it's even as small as 5%. And I usually cut my stop losses within 8 to 10% of, their entry. When I trade futures, I'm a little more aggressive because it's a leveraged market, and that's where I look to generate income. And I usually divide my account into 4 to 5, basically position sizing 20 to 25%. If I cut my losses in the 10% range, I can afford to be right as little as 1 out of 4 times, assuming my average winner is around 30%, and still be a profitable trader. So that's where it comes into play do you want to be right or do you want to make money? Because normally I wouldn't take life advice from someone who's right only 25% of the time, but I'm in the markets to make money. And if I can be profitable being right just as few as 25, as little as 25%, I'll take those odds to the bank all day, every day. So I covered a lot in this video. There's definitely more where you can get this type of educational content, and it's at TheoTrade. We have our chat room where we educate and share actionable setups with our trading members. And we have no shortage of educational content from myself and other instructors. So I hope to see you in the TheoTrade chat room. And until next time, Johnny DePoche signing off for TheoTrade. Thanks for watching, everyone.